All right, so hello and welcome to this recording, or obviously if you're joining me live on the webinar, it's great to see you as well. I appreciate you taking time out. Today we'll be talking about the Passive Income USA Commercial Property Fund. And as we talk about the Passive Income USA Commercial Property Fund, we'll be talking about how it got started. We'll be talking about some questions you may have. I'll be doing a little bit of show and tell, and then towards the end of the webinar, we'll have a time for question and answer. Now, if you are watching a recording of this and you do have any questions about any of the content that you see, please get in touch with us in the office via email or via phone, and we'll do our very best to help you. Now, I need to start with some brief legalities. Today's webinar and this recording is general advice only. This information is of a general nature and does not take into account your objectives, financial situation, or needs. You should consider the product disclosure statement dated 4 July 2018 issued by Plantation Capital Limited in deciding whether to acquire an interest in the Passive Income USA Commercial Property Fund. Past performance is not a reliable indicator of future performance. No earnings estimates are made. Part one, what I want to start with right now is to talk about a genesis about how this whole fund idea came into existence. And the question I want to begin with is, let me know if you read my book From Naught to 130 Properties in 3.5 years and thought, wow, this is a very interesting read, it's entertaining, but damn it, I can't find $44,000 properties in Ballarat anymore. And this whole notion of finding positively geared property sounds great, but I can't seem to make it work. Well, this is, I can see the comments coming in, this is the reality that many people faced, was that they read the book and they thought, wow, this just seems great. If only I had have known about this opportunity back in 2003 when it was written, or sort of back in maybe 1999 when you got started, Steve, then I could have jumped on board as well. Well, indeed. Well, I've had people coming to me ever since they read this book saying, can you invest for me? Can we give you, will you take our money and invest it? And I've always said, no, I'll teach you how to do it, but I won't do it. I won't do it for you. That's not what I want to do. I'm an educator. I'm not a fund manager. So then we need to fast forward to 2009. And in 2009, what happened was that after Millionaire Mega Conference that year, I ended up going to the United States of America to look at investing in tax lien opportunities. Now, if you don't know what tax liens are, that's buying unpaid council rates secured by the property and getting a set return on your investment, and up to 18%. So that sounded pretty attractive, passive income. So after hearing a little bit more about it, I went over to the United States of America and spent some time over in Fort Myers in Florida, and was looking around. And for instance, here's a property that I saw. This property was very interesting because it didn't have a tax lien on it as such. It was a property that was for sale. And when you could see that around the purchase price was $19,000 from memory, it was a 3-bedroom, 1-bathroom home. Very low closing costs there. It was giving a return of sort of cash on cash return of about 33%. And I thought, wow, what a tremendous opportunity. Of course, it was during the Great Recession. There was a lot of upheaval going on, a lot of asset prices being reset. But I thought, wow, this is like me seeing those $44,000 properties in Ballarat all over again, but even better, because they weren't even $44,000. They were sort of 19,000, 25,000, etc. So I went crazy, like a kid in a lolly shop, buying all these properties. I had to pay cash for them, but it all sort of looked good on paper. And then we fast forward a couple of years on, and what was happening was the economy was getting better, and these properties that were sort of 19, 20, $25,000 were harder and harder to find as prices improved. And it got me wondering, what is the next opportunity? This seems to have worked in the residential space. What is it about this market now that momentum is in my favor and trend is my friend? Residential has moved. What's the next thing to move after residential? And a little bit of education for you. What I've found is at the bottom of the market are units or apartments. Then what we have is single family homes, multi-family homes, commercial, and then at the very top of the ladder is land. So knowing that based on my real estate experience and education, I said to myself, well, what is the opportunity in the commercial space? Because real estate values in commercial had not moved like they had in residential, because residential came back first. Now, it's interesting for those of you who want to know about how markets improve and deteriorate. Markets also come off from land to commercial, then to residential singles, residential multi-residential singles, and then units and apartments usually last and least because of affordability. So that said, I also wanted to try and find a way of scaling with this opportunity, because if you're not borrowing and you want to buy a big portfolio, you have to involve other people. And then I needed to get a management solution for this, because if we're going to buy property on the other side of the world, that's going to be a challenge. So that then brings us to the Passive Income USA Commercial Property Fund. With the Australian dollar being high, with US commercial prices being low, with a groundswell of people who've been asking me for years and years to put an investment opportunity together, I finally said, right, the stars have aligned. I've got a good feeling about this opportunity because the numbers stack up, there's profit to be made, momentum, trend is our friend. Like I said, Australian dollar high, buying at a fraction of replacement cost, so there's a floor under value. If we're ever going to do it, let's do it. And I bought an unlisted public company which had an Australian financial services license, put together a product disclosure statement, and then at the mega conference in 2012, exactly 3 years after the mega conference in 2009, I put the product disclosure statement out there. Managed to raise $30 million at the end of 2012, and then we launched in 2013, bought our first property, which I'll show you later on in the webinar or on the recording, in, I believe, March 2013, Hanson Street. And then we gradually hit our $75 million cap. We gradually raised more and more money. And then as we raised money, we would invest it, then we'd open up for more and we'd invest it, and so on and so forth. And then we finally hit our $75 million cap and had to close off to new and top up investments, which then brings us to this year, 2018. We had a unit holders meeting and we decided to increase our cap, which is what the opportunity for you guys to invest in is all about. Today's webinar and this recording is general advice only. This information is of a general nature and does not take into account your objectives, financial situation, or needs. You should consider the product disclosure statement dated 4 July 2018 issued by Plantation Capital Limited in deciding whether to acquire an interest in the Passive Income USA Commercial Property Fund. Past performance is not a reliable indicator of future performance. No earnings estimates are made. 4 reasons why people don't invest. The first reason why people don't invest is what I've found is they don't have enough money. So as we know, real estate in Australia is very expensive at the moment. It's not only expensive to buy, you need a big deposit, you've got to have a big loan, and then there's quite a lot of stamp duty that you have to pay when you get in. So people typically only are able to afford a small property or 1 or 2 properties, and so they don't have really diversity in their property portfolio. So they carry a lot of risk in that if that asset fails, then their whole property portfolio fails if they own it directly. Another reason why people don't invest in real estate at the moment is they don't have enough time. They're very busy people with their jobs. They like the idea of investing, but they just don't have time to get out there and find good deals, or indeed have the time to manage them effectively or add value to increase their profits. They're busy at home, they're busy at work, but they're also happy to pay for an expert's time and effort in able to find that deal for them. Third reason is that they don't have enough knowledge. So in order to find a great property, in order to have a great investing strategy, in order to bring profit to market, you need to have skill and expertise. As I say, sophistication is very important, and if you don't know what you're doing, then you are taking on risk. People also don't know how to do due diligence to ensure they're not buying a lemon, or if something goes wrong, they don't know how to bring it back on track. So that can be very daunting. People don't have the confidence, they don't have the knowledge, and so they end up just sitting still and not doing anything. And then the last reason is they don't have enough confidence, like I was indicating before. They'd like to do it, even if they've got the skill, but they can't pull the trigger. They like the idea of investing but can't execute. That said, they still want to be a part of something big. They want to be a part of something interesting. They want to have the opportunity to profit, but they simply can't do it themselves, or they'd prefer to be a passive investor. But what if you could do something? What if you only had a small amount of money, or maybe you had a large amount of money, but you didn't have the time or the skill or the confidence to be able to execute it? What about if there was an investment opportunity that I thought still stacked up as well as it did back in the early days, with 6 monthly income distributions, capital growth upside, and the average return over the past 5 years of 16% and a little bit over? What about if this investment opportunity was affordable? It was real estate backed, commercial real estate. Minimum investment was only $10,000 with $1,000 increments thereafter. You didn't have to pay any stamp duty, so the value of your investment wasn't being eroded. You could have diversity because you would have an interest in a wider portfolio, 35 properties at the moment across 3 states, Dallas or Texas, Georgia, and Florida. Variety of building types, giving us diversity as well, and a variety of tenants as well, so we're not having all our risk vested in one tenant. What about if it had expert management? It's something that I was doing, so you were investing with me. Indeed, most of my time these days is spent managing the USA property fund and running teams here in Australia, and also teams in the United States of America. Always trying to find ways to increase our returns and add value to investors. So this is an opportunity, a limited opportunity, where you can actually have me do the investing for you and me managing my teams and doing the investing for you. Perhaps best of all for you guys is, although it's not passive for me, it's certainly passive for you. So the grunt work has been done by other experts. There's not a lot of aggravation for you. You're not getting phone calls in the middle of the night. If something goes wrong, it's not really your responsibility to fix it. No running around organising trades and getting repairs done. High level of accountability in respect to the information that you've provided. Regular updates, audited, so there's always someone looking over the shoulder to make sure things are done properly. And that is the opportunity that is the Passive Income USA Commercial Property Fund. If I could summarize it for you, the opportunity to own real estate, positive cash flow, capital growth upside, expert management, where you can just sit back and the work is done for you, but still receive accountability and transparency to know that your investment is performing well and what's going on behind the scenes. Today's webinar and this recording is general advice only. This information is of a general nature and does not take into account your objectives, financial situation, or needs. You should consider the product disclosure statement dated 4 July 2018 issued by Plantation Capital Limited in deciding whether to acquire an interest in the Passive Income USA Commercial Property Fund. Past performance is not a reliable indicator of future performance. No earnings estimates are made. Part 3 then, a few questions that you might have. First question you might have is, how does this all work? Well, fair enough. To begin with, I need to point out that you are making an investment in Australia in an Australian managed fund. So you take your money and you're investing in Australia in an Australian managed fund. You're investing in Australian dollars. That money in the Passive Income USA Commercial Property Fund, which is the Oz Fund, is then sent over to the United States of America into an entity called Ausiness, Oz in US or Ausiness. And Ausiness then takes that money, it's a wholly owned subsidiary, we're the only ones who own it, and invests via a little sub-entity for asset protection, a subsidiary, into direct commercial property. That property then throws off net rent, as you would imagine, with it being positive cash flow. And as assets are sold and the capital gains become realised, it then pays a dividend back to the Australian fund. That Australian fund then pays a distribution back to investors, and that distribution happens every 6 months. At the moment, the distribution is 5 cents a unit, and as we get more and more income, we hope that that distribution will increase. And then we have to also remember that as the value of that real estate that we own in the US REIT goes up, then the unit value in the Australian fund also goes up, and that's how we get capital growth in the meantime. To summarize, investors in the US commercial property fund that I've set up get an income distribution every 6 months, and the value of their units also increases as the value of the underlying assets increase as well. Some stats for you at the moment. So where are we now? July 2018. So as of May 2018, latest stats that we've got, because it takes a little while to sign off on the accounts. But as of 31 May 2018, there are 1,009 investors. The average investment in the fund is $114,000. And Steve's investment, because people often ask, Steve, how much money do you have invested in the fund, is a little over 3.8 million. I believe I'm the fund's biggest investor. So I'm certainly eating my own cooking and not asking you to consider investing in something that I haven't invested in. Indeed, I've just topped up my investment another $250,000 because I continue to believe that it is a great opportunity and I want to be a part of it as well. When will the fund end, Steve? Question 2, good question. Well, we had a unit holder meeting recently where we talked about how the fund would end. And initially when the fund was set up in 2012, I gave an undertaking to stay with the fund until my 50th birthday and then to reconsider. Well, in order to add some certainty in the fund, what I did is put a proposition forward that we increase the cap so that more people could invest if they wanted to, and at the same token I would be happy to stay with the fund up until at least the end of 2029, or alternatively if we decide to wind up the fund earlier, that would be fine too. So where we are at the moment is the fund will be wound up on or before 31 December 2029, with the REIT wound up on or before the 31st of December 2028. It may be that we wind it up a little bit earlier than that. As we wind up the fund and start selling properties, we'll start making capital distributions back to investors. Now, this doesn't mean that you need to be in the fund until 2028 or 2029. We do offer an annual redemption period where you can ask to have your money redeemed, and we will do our best to honour that. I think I'll talk about that in a second. What are the taxation consequences, Steve? It's a good question. It's a pretty detailed answer though, and I commend the product disclosure statement to you, and in particular section 9. In a nutshell, at a very, very high level, when we make those income dividends, or that we pay dividend from the REIT back to the fund in Australia, there's US withholding tax, which is generally at around 15%. And then when we sell assets and make capital gains, we have to pay US income tax at around 21%. Then there's a 5% branch profits tax on capital gains that we make, which we're still investigating the terms and requirements of potentially paying that. What I can say is that the tax that we pay in the US, the withholding tax and the income tax, qualifies, depending on your eligibility and the eligibility of the fund, for a foreign tax credit back in Australia. Now, unlike a franking credit, which is refundable, if you can't use the foreign tax credit, then it's lost. So the foreign tax credit is then used to offset some of your taxable income, eligible taxable income, and you can make benefit of it. But depending on your circumstances and depending on your structure, you may be able to use some or all of that foreign tax credit, but that's dependent on you, not dependent on us. So once again, I urge you to read section 9 of the product disclosure statement that talks about this in a lot more detail. How do I exit? Which is what I was sort of indicating before. Well, you can wait until the fund is wound up, as I mentioned, in sort of 2028, 2029, or a little bit earlier, and start getting capital distributions. Or alternatively, once a year, we offer a redemption opportunity. What we typically do is set money aside, and so long as the amount of redemptions is less than the amount of money set aside, everyone gets redeemed, and that's certainly been the case so far. There is the possibility though, because we don't just have cash sitting around doing nothing, that the amount of redemption requests that we get is more than the amount of money that we've set aside. In that case, the redemption is scaled back so that everyone gets a smaller amount of their redemption request. So there's not a guarantee that you'll be redeemed when you ask to be redeemed early, but we'll do our best to make sure that we try and accommodate as many people as possible. Again, the product disclosure statement talks about this, but you should be aware that this, when you invest in real estate, You sacrifice some of your liquidity for the sake of return, which means that you may not be able to get out as and when you want to, depending on available cash resources. You are also welcome to sell your units privately to other investors. That's up to you. We don't make a market. We don't find people for you. We offer the annual redemption, but if you want to redeem outside of the annual redemption, then you can do it. We just ask that the people who you sell to have to qualify with our normal application process, and then we just register the transfer at our end and it's done. So, Steve, what could go wrong? It's a very good question. Let's cover off some of the risks here. The risks are all mentioned in the product disclosure statement, but some of the risks are, for instance, the Australian dollar could appreciate against the US dollar because our income is in US dollars. Then a stronger Australian dollar means we get less Australian dollars for our US dollars. There could obviously be an economic downturn. Typically, economic downturns affect commercial property. They affect commercial property because vacancy rates increase, there's downwards pressure on rents, and then that feeds into downwards pressure on property prices. We could have an unfavourable tax change, something to do with foreign ownership, or alternatively, perhaps tax rates could go up. We can't sell when we hope to sell for the prices or the time that we hope to sell. You may not be able to be redeemed, so liquidity, as I've mentioned. Management problems might occur that we haven't foreseen, either in Australia or the US. Obviously, something could happen to me. Just in respect to key person risk, understand that I'm one of 3 board members, and while I do have expertise that I obviously contribute to the investment, it's not all centered around me. We also have management teams in Australia and the US that really do much of the heavy lifting. I just come in and run those teams. So if something was to happen to me, I was to die or become disabled, then I'm very, very confident that the skills that I have could be replaced in staff or at an executive board level, and the investment would carry on. Obviously, I'm not planning to die anytime soon, and my health is generally very good. What could go right, Steve? Very good. Well, what could go right is what's happening right now. We're finding that income is going up, there's upwards pressure on rents. The value of our property portfolio is increasing as rents go up and as yields go down because the market's getting better. We're also controlling our expenses as we move our leases from gross leases to triple net leases, so passing more of those on costs back to tenants. The Australian dollar has gone down, as we'll take a look at a little bit later on. That is good for us because our US dollars buy more Australian dollars, so investors get a return. And then because our assets are in US dollars, as the Australian dollar goes down, the value of our property portfolio in Australian dollars goes up. I think I said as the Australian dollar goes down. We could have favourable law changes. Indeed, we did. The tax rate under Trump has just been lowered to 21%, which made investors in the fund a couple of $1 million. So whatever you think of Trump, he's done good things for the fund. Question 6, how's the fund performed to date? Well, I need to say out of the gate that past performance is not an indicator or reliable indicator of future performance. That said, the fund has performed very well. If you would have invested $1 back in 2013, up until the end of May 2018, you'll have received 39.6 cents in income distributions. You will have received 47.82 cents in growth, which means your total return of about 87.42 cents equates to an annualized return over those 5 years, 2013 to May 2018, 5 and a bit years, of 16.14% per annum. And that would put this fund as one of the top performing funds in Australia, even though it's sort of relatively private. The money's been raised off the back of the database of PropertyInvesting.com. It's still a very, very healthy return for a managed investment fund, and this return is net of fees as well, just not the contribution fee, net of management and performance fees. We do publish how the fund has been going at PassiveIncomeFund.com. And you can see this graph change over time. If we look at the total return, you can see that it's relatively steep. The unit price, which is the bottom one, just sort of is reasonably static, which means that we're sort of distributing the profits that we're making. But if we look at the total return, which is the top, you can see that it's been going up at a pretty healthy rate. If we look at the Australian dollar, some points that I want to point out to you is that back in 2001, and I remember this because I was visiting my brother in Houston, the Australian dollar dipped below 50 US cents. I remember going to McDonald's and thinking, wow, all these prices I see on the board are double. We then fast forward really to the middle of 2008, just before the global financial crisis, and we see the Australian dollar was almost at a dollar US, but then it tanked during the global financial crisis to just low 60s before recovering and hitting a whopping $1.10. In fact, I remember the day it hit $1.10 US. That was around the time that I had a lot of money invested in the US, and was thinking, wow, I've got to find ways of doing even more here, which is why we got the fund set up midway through 2012 when the dollar was high, and then managed to seed the money into the US and catch this downswing, which is one of the reasons why the fund has performed so well. In recent times, you can see the dollar has been trending between 70 and 80 cents, just bouncing around there. My own feeling is that as interest rates in the US go up, things in Australia remain stable, or interest rates don't go up as much in the US, that you'll continue to see improvement in the US dollar. And as we see improvement in the US dollar against the Australian dollar, that will mean the Australian dollar should go down, particularly with this interest rate differential between Australia and the US, putting downwards pressure on the Aussie, which will obviously do good things for the fund if that was to transpire. Today's webinar and this recording is general advice only. This information is of a general nature and does not take into account your objectives, financial situation, or needs. You should consider the product disclosure statement dated 4 July 2018 issued by Plantation Capital Limited in deciding whether to acquire an interest in the Passive Income USA Commercial Property Fund. Past performance is not a reliable indicator of future performance. No earnings estimates are made. Portfolio summary. So just some high level numbers for you so you know where the portfolio is at the moment. We own three properties in Texas. That's $14 million, 14%. The reason why we wanted to buy properties in Texas to start off with is we saw it as a bit of a risk play, in the sense of the economy does well. It's underpinned by oil and population improvements. The problem with Texas is the yields aren't great because it's a more stable market. You're looking at cap rates which are 2 to 3% lower than what we can get elsewhere. So we never really bought that much property in Texas, and we've actually been selling some property in Texas. We've sold one property and we've got another property up for sale. In Georgia, we own 10 properties. This is Atlanta, 43% or 43 million, or 43% of our portfolio. And in Florida, we own 22 properties, so some smaller value properties in Florida to increase the number and give us diversity. Again, around 43 million or 43% of our portfolio. Brings our total portfolio value at 31 December 2017 to just a touch under 100 million US dollars. So that's where our portfolio is at the moment in terms of splits. Industrial 28 or 79% of the portfolio, and retail 7 or 21% of the portfolio by dollar value. So we own properties in Texas, Georgia, and Florida, and we own industrial properties typically used for flexible purposes, warehousing and office, and we own retail, typically strip shopping malls to a variety of tenants. We'll have a look at some of those a little later. Loan to valuation ratio, so the amount of leverage in the portfolio is quite low at the moment. We're sitting at 19.6%. The product disclosure statement outlines that any one property can be leveraged up to 50%, so long as the portfolio overall at current market value is 40%. Vacancy at the moment in the portfolio is at 5 July 2018. It's bumped up a bit. It was sitting at around 6. It's gone up to 8. This is usual for this time of year. It's the summer in the US, summer holidays, and so businesses generally contract a little bit. It's the equivalent of the sort of December, January period in Australia where a lot of people go on holidays, so businesses tend to contract. Typically, anything less than 10% in a commercial portfolio is outstanding, and I think an 8% vacancy or 6% as it got down to is a remarkable achievement and shows you how well the assets are being managed and the demand for real estate in the US. Of course, as properties become vacant, it's an opportunity for us to reset the rents, change them from gross to net leases, and find ways to increase our return for investors. Today's webinar and this recording is general advice only. This information is of a general nature and does not take into account your objectives, financial situation, or needs. You should consider the product disclosure statement dated 4 July 2018 issued by Plantation Capital Limited in deciding whether to acquire an interest in the Passive Income USA Commercial Property Fund. Past performance is not a reliable indicator of future performance. No earnings estimates are made. What about the fees, Steve? Let's talk about the fees. Let me tell you a story. Imagine that you get in the shower tonight and that you turn on the hot water system. There's no hot water, and you call out a plumber, and the plumber comes along and takes a look at the hot water system, says, I know how to fix this, goes back and grabs a big monkey wrench and comes along and whacks it 3 times, and then the unit fires up. And then the plumber gives you a bill and says, here's your bill. And you look at it, it's $500. You're thinking, $500? And he itemizes it for you and says call out fee $100, labor $100, knowing where to tap $300. And that's really what's going on in the fund here. When you pay a fee, you're paying for the expertise in managing it on your behalf, not only to find and negotiate great prices for properties, not only to find ways to increase the value of those properties, but also to manage those properties on your behalf so that you can be passive without the anxiety and aggravation. Now, how much do you pay in a fee? Well, sometimes people look at fees and they go, well, that sounds high. But if you knew the return was going to be 16% for 5 years and we could go back in time, does it really matter what the fees were when we got started if you could get a return like that? So fees need to be considered in line with the expertise and the amount of time and effort in bringing the opportunity to market and doing the work for you, and also in ultimately your upside. So that's it. Let's take a look at what we don't charge fees for. So unlike other managed investment funds, and there's another managed investment fund that offers the opportunity to invest in the United States, but residential property, we don't charge the fee structure that they charge. It's not death by a thousand cuts. We prefer to be very transparent. So the fees look a little higher when you first see them, but when you compare them to what other people charge, they're actually quite reasonable. For instance, we don't charge an establishment fee. We don't charge a withdrawal fee when you want to get out. We don't charge an exit fee when we close off your account. We don't charge financing fees to go and get financing on the portfolio. We don't charge leasing fees every time we lease something up. We don't bill investors back for that. We don't charge asset acquisition or disposal fees, which is important because sometimes managed investment funds charge this, and so they get paid for churn. So if they're buying something and then selling something and buying something, they're clipping the ticket on each way. We don't. We just say that when it's the right time to sell or buy, we'll do the right thing, not because we're getting paid for it, because it's the right thing for investors. We also don't skim profit. A lot of people, what they do is they set up a separate management company and charge rates for managing the property. We don't. I deliberately decided to set up the management company within the structure so that there wouldn't be a conflict of interest. So you effectively get paid a portion of the profit from the property manager too. So what are the fees? The first fee that you pay is what's called a contribution fee. This fee is paid by you once. The fee is 3.6% of your investment. If you choose to reinvest your distributions, there is no contribution fee. The contribution fee is charged on your initial investment and any top up that you do outside of the distribution reinvestment plan. So for instance, if you invested $10,000, you would pay 396%, 3.6% plus GST. So $396, and then what's left over, we divide by the unit price at the time, and that's the number of units that you are issued with. You then indirectly pay, so the fund pays on your behalf a management fee, and that management fee is 1.8% of the fund's gross assets plus GST. It's paid monthly, and then that money then comes to the responsible entity, and then from that money I have to pay the team in Australia. The management fees to run the property in the United States are also paid by the fund, but that's treated as a property management expense, not a fee paid to the responsible entity. These fees are fees that you pay to the RE. The third and last fee that may be payable is if we are able to get more than 12% per annum, then in that year we can pay ourselves 20% of the excess as a performance bonus. Now it's funny, this performance bonus doesn't really motivate me to work any harder or less hard. I work pretty much as hard as I possibly can to get the best return for you, leaving no stone unturned. That said, this fee is important because it's got a high watermark. So if we got, say, year one 16%, then we could pay ourselves 20% of the 4%. If we got 10% in year two, then we don't pay back the performance fee got in year one, but we carry over the shortfall into the next year. So if we then got, anecdotally, 14% the following year, there'd be no performance bonus because that excess, that 2% excess, would then go to paying the shortfall previously. This is really important because a lot of managed investment funds pay performance fee against the benchmark. And that benchmark might be how other funds perform. So if everyone goes backwards, but this fund goes less backwards, then they may say we're entitled to a performance bonus because we outperformed. I think that's nonsense. I think it should be transparent. 12% is a decent return. It's much more than most managed investment funds pay. So a fifth of the excess above 12% is then payable as a performance bonus if we hit that mark. They're the three fees. You pay a performance contribution fee to open or top up the account, indirectly a management fee, and then if we do really well, a performance fee. None of these other ridiculous fees for all these other things that some people charge for. I just like a transparent structure there. Now, I don't shy away from charging fees. I think you pay a fair fee for a great outcome. I'm not a monkey, and if you pay peanuts, you attract monkeys. Like I say, I'm no monkey's uncle. I set a professional standard. I work really hard. I've got significant expertise. I don't shy away from saying this is excellent value. And if you have any questions about fees, you're welcome to get in touch with me. Today's webinar and this recording is general advice only. This information is of a general nature and does not take into account your objectives, financial situation, or needs. You should consider the product disclosure statement dated 4 July 2018 issued by Plantation Capital Limited in deciding whether to acquire an interest in the Passive Income USA Commercial Property Fund. Past performance is not a reliable indicator of future performance. No earnings estimates are made. Part 6, show and tell. Let's have a look. This is the very first property that we bought in the fund at Hanson Street in Fort Myers. We purchased it in May 2013, paid $620,000 for it, which is $24.80 a square foot. When we see these per square foot, we need to bear in mind that replacement cost for industrial property is about $80 a square foot. For retail, it's about $100, $110 a square foot because the finish is more elaborate. So if the replacement cost is $80 and we bought it at $25, you can see how much of a discount we bought it for and where the value was when we bought. Well, Hanson Street was appraised at 31 December 2017 for $1.3 million, which means a $700,000 increase or an increase in value of 113%. Across the road from Hanson Street is Palmetto. Palmetto, again, is multi-tenant industrial. So we've got a diversification of tenants across this particular asset. We bought this one in August 13, paid an even $2 million or $31.66 a square foot, on 4.5 acres of land. So a pretty big building, about 6,000 square meters in size if you wanted to do the translation. It's gone up in value 65%, now worth $3.3 million. If we now move over to Hamlin, so this property is in in Orlando. We bought it, and these are just in order of when we bought them. So I'm showing you a selection of assets we've bought over time here. Bought in October 2013, paid 1.5 and change, now worth 2.9, so gone up 88%. This property is Eagle Plaza. This is one of the retail strip mall centers that we own in the fund. This one is in Tampa, or just a little north of Tampa. Bought it December 2013, paid 2.3 and change, now worth 3.9, nearly 4 million. So that's up 70%. You can see the sort of buildings that we like to buy now. This powerhouse, this one's in Texas. Interesting, as you'll see in a second. Again, multi-tenant industrial. The reason we like multi-tenant industrial is because we've got a number of tenants on site, so we're diversifying our risk, and flexible space, so it can be used for a variety of uses. When you buy unique space, the problem with unique space, as you'll see in a second, is that if that tenant purpose space moves out, then you may be in a little bit of trouble in reletting that space. Powerhouse we bought for 4.1 million in Feb 14. Now check this out. Only worth 31 December 17, 4.6 million, or up 13% in what 14, 15, 16, 17. In 4 years, it hasn't really gone up much in value. The reason for that is this is one of those assets that looks pretty, but just about everything that could go wrong has gone wrong. We lost a major tenant that had space, and then the so-called path of progress that was supposed to go right through this area and improve values and improve rents actually never eventuated. The path of progress went further north in Dallas rather than a little bit north to the west where this property is in McKinney. So rather than hold it at all costs, even though it's a nice property, it looks good, proud to own it with a photo, we decided to sell it and reinvest the money, and it is due to close in a couple of weeks for 4.95 million. This just shows you that these appraised values, which are independently appraised value, are, in my opinion, on the conservative side. So the sales price is around 11% higher than the appraised value, but that's typically the case because appraisals build in vacancy that isn't necessarily there, and they come in at a conservative value because basically appraisers don't want to be sued for being too aggressive. That leads me to believe that there is hidden value in the portfolio that will be realized as these assets are sold in time. Time will only tell though. Northland, this one's back in Fort Myers. This one's a great example. We bought this one for 480 grand, $32 a square foot. Bought it in 2014, just pre-foreclosure. That same property has gone up 169%. It's now worth $1.29 million. This one's in Fort Myers as well, Cape Coral, multi-tenant industrial again. You can start getting the feel for what we've bought. Bought in April 14 for $30.20. This property is now worth 1.7 million, so it's gone up 89%. Next property I've got for you is in Tampa, or in Clearwater, just across the bay from Tampa. This is an interesting story because I bought it because it was leased out to Pitney Bowes on a long lease. Pitney was a international tenant listed on the stock exchange, and they, when I did my due diligence on this asset, they said that they would close the division before they would move somewhere else because of the cost of moving. They weren't going to move anywhere else because in order to move, they'd have to move the whole division the other side of the United States of America, which would cost them millions and millions of dollars. So there was a reasoning behind the risk of having such a big space with one tenant, but it was a credit tenant and it was going to cost them a fortune to move. Well, guess what happened? They moved and we had this big vacant space. And it did take a little while to lease, but this is the beauty of having a portfolio that is diversified. Even though we had this vacant space, because we had other properties in other states, and because we had multiple tenants elsewhere, we can absorb the risk as we did. It's now been released to one of America's largest privately owned motor vehicle distributors as a parts center on another long lease. So 49 Clearwater though, bought for 3.5 million. Worth 4.7 million, so gone up 34% in value, notwithstanding that we had that tenancy glitch for a while there. Texas Star, this is multi-tenant industrial flex in Dallas. Nice looking property, bought in July 2014 for shade under 4. It's worth 5 even now, so it's gone up in value a little bit. Again, we're not getting the big value jumps in Texas because it's a different market. It's a stable market where the returns are a little bit lower. 932 Northeast 24th. This is an interesting story. It's 14 1,000 square foot units, so all up 14,000 square foot. Bought $480,000 in September 2014. Now worth $970,000, or up 102%. But what we plan to do with this property, and we're in the midst of it right now, so if you were to invest, you'd get the value bump here, is we're actually in Australian language, strata subdividing each of the units. So we're going to end up with 14 units that we can on-sell. And our estimation of the value of those units is 100 to 120,000 each. So 14 at 100,000 is 1.4 million, and you can see it's been appraised at 970. So I think there's a value bump that we're going to realize here, bringing these assets to highest and best use. 350 Tech, this is a nicer looking property, multi-tenant industrial flex again in Atlanta. This is fitted out for office warehouse, bought for 3.9 million in January 2017, 5 acres of land. I mean, if this property was in Sydney, if it was 5,000 square meters in size in Sydney on 5 acres of land, how much do you think it would cost? It would cost tens of millions of dollars. But United States, values are cheaper, which gives us better buying power. This property is now valued at 5.3 million, so it's gone up 38% in just over a year and a half, which is a solid outcome for investors. So when you look at the gains that are made and then you compare it back to the sort of fees that are being charged, I don't have stories about how I negotiate, but those of you who've been to Millionaire Mega Conference know that the way I negotiate and the prices that I'm able to pay, the savings that investors get just in terms of price reductions off asking price is massive and more than pays for the fees that people pay in terms of a contribution fee. This is the last property that we've bought. This is 6564 Tara, a bit unusual. Normally wouldn't buy properties like this. It's outside of our scope. But what was unusual about this one, I'll just run you through the price details first. April 17 purchase for 535, so 90 bucks a square foot, a bit more expensive. Appraised later on in December at 680, so up 145 grand. You'll see why in a second. But the reason why we bought this site is because with this property, we own, let me just grab my highlighter here, we own Shops of Tara. So we own all of this property, shopping mall that we own in Atlanta. And what happened is that the subject site, which you can see, so this site here came up for sale. And we wanted to buy it because as cars come this way, we wanted to make sure that we had our street frontage protected, that someone didn't redevelop this site to take away our street frontage. So what we did, let me just clear this screen here so all my fancy drawings can go away. There we go. What we did is that we bought it, and then soon after we bought it, we were approached by a national tenant, brand name you'll see in a second, to build for them a purpose-built store. So we're going to split it into 2 retail spots, up the front and up the back. And that brand name tenant is Starbucks. They don't just want any Starbucks store, they want a community store there. And this will be great for our shopping center because it'll put downwards pressure on yields, upwards pressure on rents. So a Starbucks anchored site will typically sell for a yield in the 6s to 7s, whereas a non-Starbucks site tends to sell in the 8s. So we're able to get yield compression, and we're also able to increase rents because when you've got a Starbucks somewhere, it brings a whole lot of other tenants that want to be within a certain mile radius of a Starbucks. So it's exciting. This is happening at the moment. This was the site about a month ago. This is the site as of this week. Pow, gone. The other great thing about here is in order to access the Starbucks, they actually have to come through our shopping centre. That's the way the council wanted it, and of course we didn't say no. Today's webinar and this recording is general advice only. This information is of a general nature and does not take into account your objectives, financial situation or needs. You should consider the product disclosure statement dated 4 July 2018 issued by Plantation Capital Limited in deciding whether to acquire an interest in the Passive Income USA Commercial Property Fund. Past performance is not a reliable indicator of future performance. No earnings estimates are made. So what is the future? Part 7. Now, when we talk about the future, one of the things I need to say is that this is not an earnings forecast. And again, past performance is not a guarantee of future performance. But in talking about the future, one of the things that people often ask is, have I missed the boat, Steve? Is it too late for me to get involved? I've seen how the value of these assets has gone up. And is it all over? Is the story over? Now, I don't know. I can't, like I say, rub my head and give you an exact answer as a crystal ball. But what I can do is point out this to you. This is the idea of a value of an asset over time. And you can see here, if I just bring up my arrow for a second, if we start off at, this is up, I should say at the top here, we've got value on the vertical axis, and we've got time on the horizontal axis. And so we look at an asset's value that starts here, it rises up to here, it has a hiccup, goes down, and then goes back up again over time. Well, this is really what we've experienced in the United States of America. It doesn't really matter where the base is. We saw the assets go up in value till about 2006 and then fall in value quite dramatically and then go back up again. So if we look at where we are, if we look at the market peak and draw a dotted line, and then I'll just kill this little arrow here, pow, change my viewer. Back in 2012 and 13, when the fund got going, we just happened to pick around the bottom of the market. And so values bounced back off the bottom of the market reasonably quickly because markets tend to overshoot on the upside and on the downside. And as the trend became their friend and borrowing became a little bit easier, more and more people were interested in real estate. And so where we are today is we're about halfway back, maybe a little more than halfway back towards the peak of the last cycle. So if we were to look at this from the basis of replacement cost and judge value against replacement cost, a lot of our assets haven't even recovered back to replacement cost. So there's still value inherent in the asset. If we then look at historical value, well then, yeah, we're not even back to the previous market peak on a lot of our assets. So there's still value there as well, notwithstanding the whole value add proposition as we find ways to increase rents and as the whole market improves in value too. So I really believe in the narrative that there's continued value, irrespective of exchange rate, in the asset portfolio that will be realized over time in the form of rental increases, so distribution, and then also in terms of value as we do things to improve the portfolio's value, and also generic gains over time as the US economy continues to perform well. Speaking of which, oh, Steve, come on, give me a forecast. A lot of people say, give me a percentage return that I can expect out of this investment. Now, we can't do that because ASIC has specific rules around performance estimates, and there's a lot of risk and liability if you get it wrong. All I can say is that if we look at commercial real estate, I firmly believe the opportunity is better in the US than it is in Australia because the returns are higher. And I believe in the narrative that the Australian dollar has further to fall over time. Indeed, one long-term forecast that we look at places the Aussie back in the 60s in the next 3 to 5 years. And if that was to happen, obviously a fund like this would perform really well because our assets and our income are in US dollars, so that'll translate into more Australian dollars. So I continue to believe in the narrative of this investment. I wouldn't be running this webinar if I didn't. I wouldn't be topping up my own money in the fund if I didn't. That said, when we look at what's going on at this point in time, there's no doubt that the US economy is strong, unemployment is low, rents are increasing, our vacancy is low as well. So the trend is our friend. If we look at the key drivers of performance, as I mentioned, the US economy is strong. You say what you will about Trump, he has been good for the US economy. The exchange rate, the Aussie dollar has fallen from $1.10 to low 70s at the moment. That has been good because what that means is the assets that we own and the income that we earn at 70 cents delivers a reasonably high return in Australian dollars. There's upwards pressure on rent. There's also upwards pressure on capital appreciation. So it continues to tick all the boxes that I looked for when I bought the investment way back in 2012 and 13. The other thing is that although some of the value has been realized in terms of the Aussie dollar going down from where it was and asset values coming back, you guys who are investing today have a different risk portfolio. or different risk profile. The reason being is when we got started, we didn't know what we were going to buy. We didn't know what was going to happen to the Australian dollar. We didn't know how we were going to solve the management solutions. You guys do. You can see the properties that we bought. You can look at the management team and you can look at the historical performance of the fund. So your risk dynamic is different. And so that said, you have to judge whether the upside of being right is worth the downside of being wrong by enough of a margin to go ahead. And that's a choice that you'll need to make. Available capital. So as I mentioned, we recently increased the cap on the fund, which was self-imposed from $75 million to 100 million issued units. And what that has done is given us the opportunity for the first time in a while to offer existing and new investors the chance to top up or become an investor in the fund. We've set aside $5 million of capital. Once that $5 million is taken, then we will close off the fund again until that money is deployed, and then we'll open back up. Now, just on this point, it's very important because to date we've raised in the first week and a bit 2 million or more than 2 million of that 5 million. So because I know people want certainty, what we've decided to do is everyone who puts in a completed application form, which means application form, investment sum and ID as required if you're a new investor, or top up form and investment sum if you're an existing investor, then we will honor your application even if we go above the 5 million. That gives you the certainty that if you want to sell assets or move money around, then you know you'll be in, unlike previous years where when we hit the target, we closed off. Beyond July though, there'll only be the opportunity to invest up until we reach that 5 million. So if we only get 4 in July, and we've got 1 million carried over till August. Once we hit that million in August, we'll be shutting off. That's why it's very, very important that if you want to be guaranteed an allotment of units in the fund in this intake, then you really should try and get your application form in July to take risk off the table. We always get a flood at the last minute. The way we try and manage that though is say if you get your application form to us, I think it's by the 20th of the month, then we'll give you interest on a pro rata basis. So hopefully you're no worse off having your money just parked with us for those days rather than leaving it as a rush to the end of the month. So if you'd like to earn some pro rata interest on your application money while it sits in the account, which will then be applied to issuing you with more units as outlined in the product disclosure statement, then there's no reason to delay. You can get your application form in now if you so wanted. Investor ranges, so serious investors in the fund are sort of 200 grand or more. I think I showed you I was in for 3.8 million, for instance. Mid-range investors, I think the average investment in the fund was 114,000, so 100 grand plus. But an entry-level investment, because I wanted to try and give people the opportunity to invest in this, even if they didn't have a lot of capital, it's only $10,000 with $1,000 increments thereafter. If you want to top up, then it's $5,000 with $1,000 increments thereafter if you're an existing investor. Now, for more information about the fund, and it's quite a comprehensive document, I commend you to the product disclosure statement, which you can access if you're a new investor at passiveincomefund.com/new-investors, or if you're an existing investor, passiveincomefund.com/existing-investors. It's important that you go to the right link for your circumstances because you will need a top-up form, which won't be available under the new investor link, or you need a new investor application form, which won't be available under the existing investor link. So make sure you go to the right spot. So just as we open up to questions, let me also say if you do have any questions about the fund or the product disclosure statement, you can get in touch with us at passiveincomefund.com or call or send an email, admin@passiveincomefund.com, or alternatively you can call the office during business hours, usually 10 a.m. to 4 p.m. 03 8892 3800. Today's webinar and this recording is general advice only. This information is of a general nature and does not take into account your objectives, financial situation or needs. You should consider the product disclosure statement dated 4 July 2018 issued by Plantation Capital Limited in deciding whether to acquire an interest in the Passive Income USA Commercial Property Fund. Past performance is not a reliable indicator of future performance. No earnings estimates are made. Excellent. Right, let's move into a period of question and answer. Now, what we can do is with the the amazing technology we have with the internet, is that if anyone has any questions and you've got a web mic, you can actually raise your hand and we can talk in real time. And we can talk over the internet like talkback radio, and I can answer any questions that you might have. You just need a web mic to participate. Otherwise, if you have a question, I welcome you to type it into the box and I'll do my very, very best to answer that for you now. One of the questions we've got from Kari is, what is the current value per unit? I think you need to go to passiveincomefund.com there, Kari, and that will show you what the unit price is. You won't know what your issued unit price is until the end of the month, but as an indicative value, you can use the previous month. I think it's about $1.43 from memory at the moment. Thanks for asking the question. Sean, you've got your hand up. Would you like to ask a question? Just give you a second, Sean. It says you've got your hand up, but not hearing you at the moment. Are you muted?
Yeah.
There you go. Got you now.
Hello.
Yep, I've got you, Sean. What's your question?
Yeah, Steve, I was wondering what's the best structure to hold unit?
There's not
Yeah,
really there's not really a best structure as such, Sean. It all depends on your own asset structuring and the way that you want to protect your assets and structure the way you control your wealth. People in the fund own in their own name. They own in partnerships, companies, trusts, super funds. There's a whole mix of different entities that people have used to invest in the fund. Is that okay? All right, I assume that's answered the question. Thanks for asking it, Sean. If anyone else has a question they'd like to ask, just pop up your hand. On yesterday's webinar, we had hands going up left, right, and center. So let's go back to Jad's question, which he asked before. Hi, Steve. Can you please discuss if you will leverage our funds? So leverage in the sense of there is some debt that we've got in the fund, which is unit holder, which is debt that we got when we bought the property off the seller, and also two debt facilities at the moment with lenders, one which is a life insurance company and one which is a commercial backed securities lender, which they then sold it on to Wells Fargo. So we've got some traditional finance in the portfolio and a little bit of vendor finance in the portfolio. Fiona asks, aren't we now disadvantaged by the lower dollar? Well, Fiona, disadvantaged in the sense that those people that got in early got the benefit of the dollar going down, and those people who get in now get that benefit in the sense of the income distribution being in lower Australian dollars, but the value is built into the unit price. So the dollar would have to go down further, or the assets would have to go up more to get an uplift out of that exchange difference. Of course, if you thought the Australian dollar was going to appreciate markedly against the US dollar, then you have to think carefully about this, whether this is the investment for you. Chris asked a question, how did you determine the 12% hurdle given historical 16%? Well, Chris, the 12% was set before the fund got started. So because it was set before the fund got started, we didn't know about the 16% that was going to happen. We just figured that if we benchmark 12%, given that a lot of other managed investment funds benchmark 8% in the research that we did back in the day, we figured that we were setting it above the industry average. So it would really need to be a genuine outperformance in order to get that performance bonus. Historical return, 16%. What proportion of the total return is attributable to currency movement? I don't have those numbers in front of me, Chris, but if you get the financial statements that we make available at the website, passiveincomefund.com, I'm pretty sure that we publish the attribution there. Sharon asked, does the return of 16% include the fee? It includes fees, Sharon, but just not the contribution fee that you pay out of your own account at the beginning. It does include the ongoing management and performance fee though. Chris asked, please discuss gearing from a fund perspective. Yep, I think I've done that for you, Chris. That's a question you asked earlier on in the webinar. Kari, I can see that your hand is up. Did you have a question? You there, Kari?
no. Peter here. It's actually Carrie. I'm listening, Steve.
All right, Peter, welcome.
Thank you. With the application, if you want to invest whatever, you have to have the money in your account before the 31st of July.
That's right. We need a completed application form. And when we say completed application form, if you're a new investor, then we need your application form properly filled in. We need your certified identification as outlined in the product disclosure statement for proof of identity. And we need your investment sum in our bank account before 5 p.m. on the 31st of July.
So I can give a check, because if I try to do electronic fund transfer, I'm limited on a daily.
So long as if you send a check, then the date that we receive your check is the important date. So long as we receive it before the 31st of July, it doesn't need to have been banked and cleared. So long as we can bank it by the 31st of July, that's fine.
Okay. Well, I'm Melbourne based. I'm close to the office, so I can always drop things off.
Yep, absolutely.
Okay. Next question.
Yes, sir.
Do you hedge to protect the movement of dollars?
That's a good question. We don't hedge. We have received advice and continue to receive advice about the upside versus the downside of hedging. Now, hedging is very, very expensive for the risk that it tries to mitigate. So our position is that while the Australian dollar bounces between 70 and 80 cents, if we were to hedge, we're really paying for churn. For instance, by not hedging, we've sort of saved the fund about $3 million so far for risk that wasn't really there. Our position, though, is that if the Australian dollar was to fall down, what we would want to do is lock in that exchange rate gain with a hedge and then simultaneously begin to liquidate the portfolio and return money to investors. So we're really looking for the best time when the exchange rate and property values intersect between now and 2028 to lock in that lower exchange rate via hedging and then begin to realize the assets and return the money to investors. But to answer your question, we've looked at the upside versus the downside of risk of hedging, sought advice on it, and at this point in time, we don't believe that the risk that is in the portfolio is worth hedging for the cost.
Okay, thank you. Can I just ask one more question?
Of course, I'm here to answer questions.
Okay. I know cycles are all over the place, but generally speaking, I think the cycle is about a 10 to 14 year cycle. So if you take a 14-year cycle, when the markets have a mid correction and have a recession and go back up again, 2029 it will be probably in a recovery period. I know you can't crystal ball and stuff like that, but we've had a very strong bull market. Talking about shares here, I know we've been going up for the last 9 years. That's a big bull market.
Yeah, like commercial real estate's gone up in value like I showed, but it still hasn't reached the previous peaks. I know in the stock market we hit new highs being announced, but it's not like that in commercial. It hasn't had that uplift factor. Remembering that money's very cheap in the US, but the liquidity never really came back like it used to for commercial real estate. So you're right. We move in cycles, and I don't know what the property market's going to be like in 2028. But we're not just going to get to 2028 and decide to sell all our assets. We're going to dollar cost average it out over time. And then if the market isn't favorable, then we'll have to look at other strategies to try and ensure that we get investors the best return that we possibly can. That's the art.
Obviously, you do a yearly analysis. When you've got more growth, you obviously off-sell as you do in your course and stuff like that.
Yeah, well, I mean, the assets get valued every 6 months. And when we get to a point where the yield is so low against those assets that it's not worth the risk anymore, unless we're getting continued growth, the best thing that we can do for investors is say, look, this asset's done really well. It's time to sell it. If we can't redeploy the money in other assets, we'll be returning it.
Okay, sorry, another question. I noticed in the graph that you had a lot more growth in the capital growth than the units because you're giving out units. So I gather that there's built-in growth in the fund because people who invested first got an obviously probably $1 unit. It's now about $1.43 a unit. But I noticed that the growth is higher. The capital growth is higher. So when you sell those, will the new unit holders probably benefit out of that?
Yeah, well, if we've got an asset that is valued at $1 million, but we're able to sell it for $1.1 million, then all unit holders in the fund at that time will benefit from that extra growth that can be realized when we sell. If you look at the graph, maybe I wasn't clear when I explained it before. The graph is, one is just the unit price and the growth in the unit price, and one is the unit price plus the distribution. What you can concur or conclude by looking at that graph is that the unit price over time has been stable. That's partly been because the Australian dollar has been recovering off where it hit in 2006 at the same time as us distributing back to investors. So every time we make a distribution, like a share price, the unit price goes down. And then it recovers, and then the unit price goes down. That's the peaks and troughs of the unit price as it goes X and come distribution.
So the 5 cent per unit is minimum, or is that just what it is?
It is just what it is, because with this REIT structure, we have to distribute at least 95% of the income. And the way that we do that is we just benchmark it every 6 months, even though the 95% is annual. And then when we look at the amount of cash that we've got available, we decide how many cents per unit we want to do as a distribution.
Okay, so but the capital growth hasn't actually been realised, or when you value, that's been realised into the unit price. That's why you get a valuation. So it's a notional value of what the unit's valued at.
Well, it's notional, but it's independently valued. It's not a made-up director's valuation.
I'm not saying that at all, but it's based on someone's opinion.
Well, an expert opinion.
Expert opinion. But you're saying those expert opinions, which is, I believe, is correct, is because it's undervalued rather than overvalued.
Well, they tend to be conservative because they've got risk if they come in aggressive, and then they also do things like factor in vacancy, even if there's no vacancy, because they come at it at the point of view of what would an arm's length investor do. They would allow an amount for vacancy, but if the property is on long-term leases, they still allow an amount for vacancy. So, this is just their valuation methodology, which is why I think the valuations that we have are on the conservative side, and there'll be value for investors. Let's leave it there.
Okay, thank you. Thank you for your time.
Yep, no worries. You're welcome. It's just other questions. Let's move on. Key man risk. If you get hit by a bus, ask Chris. I believe I answered that earlier on in the presentation. We've got a board here in Australia, 3 board members, and we've got the team in Australia and the US. So I don't think you imagine that I do the transactional side of things for the fund. I bring executive oversight and expertise. If something happened to me, then that expertise and executive oversight could be found elsewhere, I'm pretty confident. All right, Tashi asks, thank you for your presentation, very comprehensive. Current US debt sits at 21 trillion with some compelling indicators of another financial dip. How does that factor into the portfolio survival scheme? I guess that speaks to the strength in the US economy and the ability of the US economy to be consistently resilient. If you believe that the US economy was shaky, or you thought that it was going to deteriorate over time, then you'd have to consider whether this investment's right for you. My own thought on that is that the US economy is diversified. It's one of the only economies in the world that actually doesn't need to import anything. It does because of its scale, but it's self-sufficient in respect to energy. Therefore, if we look at where do you want your money, you can either have your money invested in Australia, which is a tiny economy with geopolitical risk, or alternatively, you can have it invested in the US. That's why I've always thought that the US has been a better diversified market to invest in. Laura asks, please ignore the second question, just the first one. Righto, Laura, let's go back to your question, make sure I've got the right one. Can you invest if you are not a permanent resident? Look, Laura, you can. It's just that if you're not a permanent Australian resident, your tax situation just becomes tricky because you're investing in Australia to invest in the US. So make sure you know what you're doing from a tax perspective if you're not an Australian citizen or permanent resident. Just makes it a little bit trickier. Chris asks, can I explain the gearing policy? I think I did that again, Chris. The gearing policy of the fund, the LVR at the moment sitting under 20%. We can have up to 40% gearing in the portfolio and any asset up to 50% geared so long as we sit at 40%. But generally speaking, the portfolio leverage at the moment is about half what it could be. Again, that speaks to the quality of the return because we're not leveraged up to the max of it. Fiona wants to know, can I please explain what I mean by $1,000 increments? That's right. Sorry, Fiona, if that's not clear. So minimum investment's $10,000 with $1,000 increments thereafter. So 10,000, 11,000, 12,000, 13,000, 14,000, not $10,250 or anything. So nearest $1,000. So we allow $10,000 and $1,000 increments thereafter. If you want to invest 50, 51, 52, 53, 54, etc. So you're welcome. Chris asks about the PDS, says unlikely to be hedged. I think I've explained that too now, Chris. Thanks for asking that question. We reinvest the distributions without any Australian tax consequences. No, or can we? No, that's not right, Chris. When we give you a distribution, that triggers a tax situation, and then it's your decision to reinvest back into the fund. So there'll be some issues there in terms of you'll have to handle your tax, like any kind of dividend redistribution as well. Steve, will you consider buying properties in other countries? Asked Charles. No, it's only the United States of America in this fund. Scott wants to know, when it comes to winding up the fund, do you have a set exchange rate that you'll stick to? Well, the exchange rate is when we send the money back from the US to Australia, the spot rate at that time, unless we've hedged, Scott. All right, Shayhan. This might be an annoying question, but can I move some or most of my super, which is not in the self-managed super fund? No, Shayhan, we're not sort of a product that industry super funds would consider investing in because we're seen as boutiques. So it's really only self-managed super funds that are going to be able to take advantage of this opportunity, or alternatively, individuals, companies, trusts, etc., outside of superannuation. Steve, are there any education components we get by investing in the fund? Asked Jad. And I saw you ask that question earlier too, buddy. I was just coming up to that. Yes, look, in the past, I've had unit holder meetings where we create educational opportunities to talk about the fund. That'll happen going forward, but just via webinar, I think, and then a once a year live seminar. I also gave people who invested in the fund the opportunity to come to Millionaire Mega Conference as my guest. Because I'm not doing any more Millionaire Mega Conference, that opportunity has now ended. But certainly the catchphrase was learn while you earn with the fund. And I do go to extra lengths to try and use it as a teaching tool for people who are interested. Fiona asked, does the fund pay US taxes? Yes, the fund pays US taxes really on behalf of investors. So you won't have to lodge an income tax return in the US, Fiona. Once the EFT is paid, how long after do you expect to receive the application form? Orleen, what you do is you download the application form as part of the PDS, you fill that in, and then you make the EFT payments as outlined on the application form. So you send in your application form and your money at the same time. Could you choose to be paid in US dollars rather than Australian dollars? Asks Abdul. No. Because it's an Australian fund, you make the investment in Australian dollars and you get paid in US dollars as well. What happens if I die during the term of the investment? Then what happens with the investment is that it will go to your beneficiaries in your will, and if they choose to want to redeem, then they can put in an application for redemption when we do our annual redemptions. Can an investor with US dollars invest in the fund? Asked Chris. No. We need Australian dollars because it's an Australian dollar fund, Chris. All right, so I will just see if anyone has any other questions and you want to raise your hand. Now's the chance to do it, or if you have a question and you want to type it into the box, that's fine as well. Happy to answer any other questions. Otherwise, we'll wrap up. Must have done a really good job in the last webinar because it doesn't look like we've got any other questions. Oh, Jad, respectfully, would you be better off using your own money and leveraging it, say 80%? Jad, you've got to figure that out. You've got to decide whether or not you want to have the risk of leverage and do that, or invest in the fund. For instance, I've leveraged off other Australian assets that I've got to invest in the fund rather than leveraging in Australia to then invest in Australia. So that's why I do what I do. So yeah, oh, you're asking for me, yeah. So what I've done is I've leveraged off other assets that I own to increase my investment in the fund. Alrighty, folks, I think that's the end of the questions. Oh, the fees again, asked Laura. Just to double check, you can actually get these slides. They're in the handouts right now. I should have said that at the start, shouldn't I have? But you can still download them now if you want, and that's got a copy of all these slides that I've covered in them. David wants to know, will I be expanding the states? It's not our expectation to do so, James, at the moment, but we can if we're still trying to find better value opportunities. I think our management is centered around Texas, Florida, and also Georgia. And so if we go to a new area, we've got to set up a new management pipeline. And so we've tried to avoid doing that. Is this the last webinar? Asked James. Yes, it is. Will you be expanding? I've answered that. If you're a US citizen, what are the tax implications? David, you'll need to go and see someone about that. I'm not an expert in that field, but I don't know that this is the right opportunity for you. Make sure you get advice, because if you're a US citizen, you're investing in Australia to invest in the US. Laura wants me to go over the fees again. So Laura, just go back to the product disclosure statement. If you have any questions, by all means, get in touch with us. We'll just come back to Kari's partner. Is your hand still up? Did you want to ask another question?
No, sorry, that was a mistake. Sorry about that.
It's all right. Thanks for your questions earlier on. All right, folks, that brings us to the end of the webinar. Let me say thanks very much for watching the recording. If you're watching the recording, or thank you very, very much for joining me live. If anyone has any questions about the fund, just get in touch with us. Be sure to get your application in if you're interested and want to be in the July guarantee allotment. Otherwise, thank you very much for watching, and I wish you all the very best. Bye for now.